Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
We need to start right with the final price action of Amicus Therapeutics, that's FOLD, as it was acquired by BioMarin. The market's reaction, right after the announcement on December 19th, 2025, it was incredibly dramatic and I think very telling.
Absolutely. It was a textbook merger arb scenario from the first tick.
Exactly. The stock just gapped up immediately, closing that day at $14.18. And this was on staggering volume. We're talking over 40 million shares traded, and it settled just 32 cents shy of the definitive all-cash offer of $14.50 per share. So this tiny difference, it established a very tight arbitrage spread right out of the gate.
Actually expose a deep undervaluation, what some shareholders would call a take-under. So, my position is that the $14.50 deal is financially justified, and it's actually confirmed by market efficiency and strong governance.
And I'm going to argue that we just can't look at that $14.50 price in a vacuum. I think when you consider the heavy pre-deal market activity, the company's financial milestones that were just around the corner, and what analysts were saying, that offer is substantially below Fold's actual long-term potential. The very market mechanics you're pointing to, especially that massive institutional buying, I think they confirm the undervaluation. They don't justify the price.
My position is that the $14.50 offer is robust. It provides shareholders with definitive, certain value. We have to start with the premium. This all-cash deal gave a really substantial and indisputable premium, 33% above the previous day's close of $10.89. But if you zoom out, the premium's even more compelling. It represents a 358% markup compared to the 60-day volume-weighted average price, the VWAP. And for listeners who might not be familiar, the VWAP is, well, it's essentially the average price weighted by volume over those 2 months. It gives you a much truer picture of where the stock was trading before all the acquisition rumors got serious.
Right.
Beyond that premium, the valuation is fundamentally sound. Look at the financials. The total transaction value, about $4.8 billion, translates directly to an 8.0 times revenue multiple. This is based on the $599 million in combined net product revenues from their key assets. In the biotech world, an 8 times revenue multiple is, well, it's robust for a specialized rare disease company, especially because BioMarin is specifically paying for a long-tail, de-risked cash flow stream, a stream that's basically guaranteed until 2037 because they sorted out the patent litigation on Galafold. The immediate price settling at $14.18 just confirms that the professional market sees $14.50 as the rational hard ceiling, with that 32-cent discount just covering the 6-month duration risk until the deal closes.
I see why you think that, I do. But that 8 times multiple and the historical premiums, they completely miss the most critical factor here. The company was at an inflection point. The acquisition price, it fundamentally fails to capture the value of Fold's imminent transition. Management had actively guided the market toward achieving positive GAAP net income. We're talking true accounting profitability during the second half of 2025. When a biotech company transitions from a loss-making entity, which trades on potential, to a profitable commercial enterprise, its whole valuation paradigm shifts, often leading to huge multiple expansion. $14.50 locks in the multiple of a pre-profit company, not a post-profit one.
But that's a projection, not a reality yet.
It's a projection the company itself was guiding to. And if we look at objective pre-acquisition analyst expectations, which are often based on really detailed models of these profitability shifts, the bullish price targets were as high as $20 or even $22 from major firms. This massive discrepancy between the final deal price and those fundamental projections, it strongly suggests that $14.50 fails what shareholder litigation often calls the best possible consideration test, meaning the board might not have gotten the highest possible value. And let's be specific about where the value was missed. The deal structure. It only valued the commercial assets, Galafold and Pombiliti. This effectively treats significant late-stage pipeline assets like the phase 3 drug DMX-200 for FSGS as a free call option for the acquirer. A free call option basically means BioMarin gets to keep the massive, unlimited future upside of that experimental drug without paying Fold shareholders a dime for it today. That upside should have pushed the valuation considerably higher.
That's a critical distinction, I'll grant you that. But let's dig into this idea that the market knew it was undervalued. You mentioned the pre-announcement trading. Let's really delve into that microstructure, because I would argue that those movements confirm your point that the price was too low at the time, but they don't justify a higher final negotiated price.
Absolutely. I contend that the massive institutional accumulation we saw in the days leading up to the announcement, specifically trades done in dark pools, confirms an extreme undervaluation. When we look at the daily volume spikes, they're just staggering. Trading volume surged from a typical, 4 to 6 million shares a day up to 12.05 million on December 12th, and then it peaked at 14.25 million shares on December 15th. This volume, which is 3 times the average, was executed largely off exchange in what are known as dark pools.
For our listeners, right? Private trading venues.
Exactly. Private venues where big institutions can buy and sell huge blocks of stock without immediately flashing that volume to the public market. They do it to minimize the price impact to accumulate shares quietly. This level of accumulation, done secretly in the low $10 range, confirms that sophisticated players had highly confident knowledge of an impending premium event. They were positioning themselves. They clearly expected the price to be significantly higher than the $9.80 to $10.89 range they were buying in. That trading activity itself is the strongest evidence that the institutional market saw the stock as deeply discounted.
That's an interesting point, though. I would frame it differently. I think this high-volume dark pool activity shows market efficiency in pricing in the rumor up to that pre-deal close of $10.89. You're right. Institutions use dark pools because they want to accumulate without spiking the price. But the fact is, this accumulation did move the stock from the low 9s up to the high 10s. The market was correctly identifying that a transaction was likely and was pricing it in.
But not pricing it in enough.
The accumulation just represents institutional demand during that rumor phase. It doesn't, however, dictate the final corporate valuation. The 1450 is the definitive, formal outcome of board-level negotiation, due diligence, and financial modeling based on secured long-term cash flows. This is a negotiated valuation of the company's assets, not just a measure of pre-deal institutional appetite. You're arguing that because institutions wanted the stock at $10.89, the negotiated price should have been $22. That disconnect shows the limit of using microstructure data to challenge a formal M&A valuation. And we have to address the issue of insider selling, which, to me, paradoxically strengthens the argument for governance and market integrity. It supports the efficiency narrative. I'm talking about the transactions involving the CEO Bradley Campbell and others. They sold shares at about $10.86 on December 15th. That's just 4 days before the 1450 announcement. This seemingly questionable timing actually serves as strong evidence of strict corporate governance.
How so? Selling just before a 33% spike looks terrible.
Because these sales were not opportunistic. They were executed automatically under a pre-established mandate, a Rule 10b5-1 plan, which was adopted months earlier, back in September. So for those listening, a 10b5-1 plan is a trading mechanism designed to shield corporate insiders from accusations of trading on non-public information. It forces them to set up a predetermined schedule for selling shares based on dates or prices long before they know about something like a merger.
Right.
The key fact here is that the CEO's rigid adherence to this plan forced him to sell at $10.86. The numbers show he forfeited roughly $283,000 in potential gains by selling automatically rather than waiting for $14.50. That forfeiture, caused by the mechanism itself, exonerates management from any suspicion of opportunism. It shows they prioritize compliance over maximizing their personal gain.
I come at it from a different way. I fully accept the technical compliance. The CEO did nothing illegal, nothing improper. But while technically compliant, the very visible timing of that sale creates considerable optical friction. It just fuels the narrative that the price was kept low for the acquirer. You see, the mechanism designed for compliance inadvertently forced the highest-ranking executive to exit a big chunk of his inventory just as the company was being valued at its $4.8 billion peak. This sequence just reinforces the perception among retail investors that they, the long-term holders, were made bag holders who exited at an artificially low point relative to the intrinsic value that BioMarin's offer confirmed.
But that's about perception, not financial reality.
How can you argue for market efficiency and sound governance when the executive who knew the potential value best was forced by his own compliance plan to sell stock at a 25% discount to the final deal price? It speaks volumes about the disconnect between technical fairness and the perceived fairness of the ultimate deal price. The stock was undervalued, even in the eyes of the person forced to sell it.
The purpose of a 10b5-1 plan is governance. It's not price prediction. You can't fault a compliance measure because the timing of an unforeseen M&A event happened to intersect unfavorably with it. The market accepts the legal and financial reality of the deal structure, which brings us to the ultimate result, the arbitrage spread.
Okay.
Let's look at the current tight trading channel from 1418 to 1425. It illustrates the mathematical reality of M&A. The deal probability is exceptionally high. Why? Because BioMarin secured a massive $3.7 billion debt commitment to finance this, and there's minimal antitrust overlap. Both companies are in the specialized niche rare disease space. It's a very clean deal. For professional ARB funds, the institutions that specialize in this kind of risk, the 2 to 3% spread between the current price and the 1450 offer, realized over 6 months, that is a low-risk, viable yield. This price floor and ceiling dynamic dictates a rational rotation of the shareholder base. The high-growth, long-term retail investor rotates out, and the institutional arbitrage investor rotates in. This movement proves the broader market accepts the deal terms as final.
That's a compelling argument, purely from a math perspective. But have you considered the opportunity cost inherent in that spread for the long-term holder? For the growth-oriented retail investor who bought into Fold's pipeline and its transition to profitability, the stock has fundamentally become dead money. It's now nothing more than a bond-like proxy. It's tied to a specific future date and offers a marginal yield, but it has zero genuine growth potential. The optionality is just gone.
But certainty has value.
It does, but what about the upside? The announcement of an all-cash deal mathematically caps the price. It prevents any possibility of a traditional short squeeze. And a short squeeze, for those listening, is when a stock with high short interest, investors betting the price will fall, suddenly spikes, forcing those short sellers to buy back shares at a higher price, which fuels the rally. Fold had a high short interest ratio, 6.01 days to cover. There was a lot of betting against the stock. The certainty of 1450 came at the price of all future upside, disappointing everyone who banked on that potential $20 plus trajectory the analysts foresaw. The spread is rational for arbitrage, yes, but it's a failure for growth investors.
To summarize my position, the 1450 valuation is overwhelmingly justified by historical premiums and a robust 8 times revenue multiple for a newly profitable, de-risked commercial entity. Its long-term Galafold cash flows are secured until 2037, the immediate market action establishing that tight arbitrage spread, and the strict adherence to governance policies like the 10b5-1 plan, it all points toward an efficient market validating the negotiated structure. The price is fair because it crystallized value today.
And I'll conclude by saying that while the transaction is legally and technically compliant, that 1450 price reflects a massive discount to Fold's near-term profitability potential and prior analyst expectations for multiple expansion. The significant dark pool accumulation proves that institutions knew the stock was worth substantially more than where it was trading in the low 10s. This inevitably leads to the perception among long-term holders of a definitive take-under that failed to assign any real current value to the pipeline's critical optionality.
The transaction successfully crystallizes substantial value for Amica shareholders while transferring the execution and commercial risk over to BioMarin. The debate over whether this value was optimally shared it highlights the inherent complexity of valuing high-growth assets in the biotech sector when you're confronted with the immediate, certain guarantee of an all-cash offer.
And I think the ultimate fairness of the 1450 price will only be determined by BioMarin's long-term success. If they successfully leverage the secured cash flows from Galafold, and more importantly, if they successfully monetize the upside of those critical pipeline assets, DMX 200 chief among them, the very value that Fold shareholders gave up for 1450, well, then history will judge this a bargain for BioMarin, confirming the take-under narrative.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.